Welcome to episode 2 of The Compass. We're recording this on Tuesday, July 23rd. So for some of you who have just watched episode 1 and have given us feedback, we haven't actually seen that yet, but we're happy to take your feedback for both episodes into episode 3. We'll record it next week. So what we're going to talk about today is what we look for in a junior mining company. Pretty straightforward. I think this will be a good episode for educating on what we look for, and then hopefully help you guys as investors see what's out there, or what to look out for and what to look for. Just to start with, Sam, maybe over to you. Let's maybe define what we look for, what we consider to be a junior, and what we would call a junior from our portfolio, and we're using that vernacular because there's a big range of market caps that could cover that.
Yeah, so to try to simplify this as much as possible, I think the universe of junior investing exists in two sides. The first one is the pre-discovery side, which is when we're financing a drill program that we hope will prove some geologic model, and then you put 2 or 3 holes in it, you can put some sort of dimensions and kind of get a general sense of continuity, and say that you have a discovery. The second part of the juniors is where post-discovery, where there is a company advancing a project, significantly drilling it, which requires a significant amount of money, but also preliminary engineering work, all the point to a PFS, pre-feasibility study, or a BFS, bankable feasibility study, to the point where they actually make a decision to build it, or potentially to sell it to a bigger company that has more access to capital to finance the construction. So for us, the juniors exist in this big landscape, but we divide them into two: the exploration ones, and let's call it more like resource/development ones.
And
Back to you, Derek.
Yeah, so but I think that covers, like, just for reference, that covers companies, on those explore codes that are trying to prove an exploration model. That covers things that are 5 million market cap, and on the large scale developers, you could be into the multiple hundreds of millions market cap, almost up to $1 billion, depending on the company. So it's a bit of a wide range, but generally what we're looking at is we're looking at sort of, for the most part, pre-production when we start talking about juniors, and then I think this is what we're going to focus on for this episode at least. So much like we did last week, we'll give you a little bit of our theory and our process, and then we'll chat about some names that we're invested in right now that we think kind of fit this thesis and why we're invested in them. So I guess the simple question is, though, Sam, as these are obviously high risk companies. They're pre-revenue. If you look at it in the general scope of the investing universe, why do we invest in these things?
This is the obvious question, and the obvious answer is because you can make money in this space.
Right.
It requires a certain type of skill set, and unfortunately for you and for all of us, it requires a lot of hits and misses. We're gonna pick a lot of companies that will not turn out to be great successes, but if you have the good enough ratio of picking enough winners out of the pool of investments, the returns can be so astronomically large that in and of itself will cover all of your losses and then some. For example, a company that we were publicly supporting, if we can say that, or that we did some research on and we made an investment into, and we made it public, was Great Bear Resources. And there were people whose average cost was 20 cents and the takeout was nearly $20. That's the type of, all those numbers are obviously per share. Those are exceptional returns for any kind of investor. And more importantly, and kudos to the Great Bear team, the sale was done at the highest price ever. So it doesn't matter at which point you got involved in the story, you came out with money, regardless if you stuck with them. So that is the reason why we like this space. The returns can be astronomical. It's also quite exciting to be part of a discovery or a development story, see it progress. And, I think combined, Derek and I, we have nearly 30 years of experience looking at these types of companies, and we've learned tons over the years. And I think that's That's the reason why we're making this clip.
Yeah, I think the other thing that we look for, and this gets into it, is you look for that asymmetrical opportunity on the returns. You know, a lot of times because of the nature of the resource sector in particular, there's a lot of missed information. If you want to go with that, is that like people don't get it, right? You might see a company where they've got the 2 drill holes and they're past that discovery phase, but the market hasn't recognized it yet. Or you see a development story that has sort of multiple prongs to make money, and you know the market isn't recognizing how those returns are going to play out. And we'll talk about some of the names that we think kind of fit that category for us as well. But I think because of the size of the space and the lack of, you know, the few investors that are in it, you get a lot of asymmetrical return opportunities where your downside is much, your upside is much higher than your downside risk. And so you have to kind of weed through to find those. If you want to dig into what we look for, you know, this is going to sound a bit of like a broken record. I'm sure you've heard other people talk about it, but you know, I think this is going to sound kind of obvious when you say it out loud, but it's like, what do we look for? Well, you know, first thing is obviously people, but I think maybe just before I jump into that, we were talking about this earlier today, but like, it's kind of, when we look at an exploration or development company, we look at like risk levels in the different categories that we're going to go into, right? We're not, you know, the categories are people, access to capital, jurisdiction, what's the geologic risk or scale potential, those kinds of things. But, you know, we want to take, you know, for us, we want to take, you know, we might have a really good operator or manager could offset some of the, you know, we might take an earlier geologic take on it. You know, we're invested in several, you just mentioned Great Bear, we're invested in several discovery group companies. We view them as good allocators of capital. And so we're willing to take on some earlier stage risk, more geologic risk, because we trust the people. And so when we talk about each of these things, you know, none of these things are binary. There's no outcome, but it's sort of how we weigh each of these things as we go into an investment and think to ourselves, well, how does that fit with all the other pieces? And then what does that mean? So, maybe first and foremost, go ahead.
Before we go into the list, I think it's interesting. Like earlier this year, I was in South Africa at Stellenbosch University, and I was part of a panel with some Canadian CEOs, and a good friend of mine, Glenn Brown, organized it. And one of the quick questions that we were asked to discuss as a comprehensive group was, would you rather have a tier 1 discovery with an average manager, as in people or group behind it, or would you rather have a tier 1 group with an average discovery? And the funniest thing was that the younger part of the crowd thought that, raised their hands to support the fact that they would take a tier 1 discovery with an average management team, whereas the older part of the group would raise their hands and they would prefer a tier 1 management group with an average geological discovery. And we spoke about this, you know, after that event for quite a long time, because it was quite revealing about the things that you learn, you know, with years of experience. And I think it's a good segue to start thinking about the key things that we look for when we invest in a junior mining company. And number one, first and foremost, is people. And I'll let you run with it, Derek.
Yeah, I think people makes a huge difference, right? You know, there are management teams out there. A name we're going to talk about later is Arizona Sonoran and George Ogilvy. You know, he made mines he made an asset that shouldn't, prior to Arizona Sonoran, an asset that shouldn't work. You know, a profitable outcome for his investors, some of his investors. Whereas, you know, an average management team or an inexperienced management team provides different challenges and risks that go with it. But I think, like I said, you know, we're not, you know, there are a lot of in this mining space, etc. There are a lot of interesting characters in it, both good and bad. And I think with people, I think, you know, this is certainly something we weigh, and you want those good managers, because those good managers could turn a bad project into a good outcome from a stock perspective. The other thing, though, to keep in mind is that doesn't mean that we're only backing people who have done it before, right? I don't think that that's a risk. And the other, you know, the other thing with people, it'll lead into the next item, but the other thing is, like, how much of your money, of their own money, have they put into this venture? I mean, there's lots of studies that show the outcomes of management investment and the returns for shareholders that go with that. But you want someone who's, not there just to draw salary. They don't necessarily have to be the founder of the company or someone who has a lot of cheap stock. Are they putting, do they own stock? Are they a regular buyer of their own stock? And do they keep going? And I think that's a key thing. And that sort of leads into the next element, which is access to capital. I guess, Sam, you may want to describe what we consider good access to capital or ability to raise money.
So just to flip it over a little bit, more than access to capital, what we have seen, and we discuss this quite frequently, is the number one reason why a junior mining company project fails is because, and I'm not saying the only reason, I'm saying number one reason, is because it doesn't have enough capital allocated to it to prove or disprove the geologic model or the theory or whatever the thesis is. And unfortunately, the majority of juniors don't have access to real capital, and they leave by making small races over small races, and they never actually get the budget to push through and try to prove a point. So we invest in companies that we believe have the right management team that also has access to capital, meaning, and I'm just going to throw numbers out there, but obviously it's different case by case, but somebody can raise $5 million to drill 10,000 meters and do other work and actually prove that there is something of scale that's worth exploring further. When you're raising 500,000, $1 million at a time, you are literally operating with a gun to your head. And in this business, everything and anything goes wrong all the time, not sometimes, all the time. And when you're running on very constrained budgets, you just don't get the work done. Like, you just don't complete your project. Any delay ruins your work program. And also, we're all guilty of this in that sense, is, there is a management overhead. There is the auditors need to be paid. The TSXV needs to get paid. So when you raise that capital, it has to be substantially large that it goes into the field and actually to advance or prove or disprove a point.
Yeah, I think along those lines, even if you don't have enough capital, even if you are successful in the field, let's say you go drill a great hole. I've got the stripes to wear on this one, but you don't have capital to go back it up. The market's not stupid. The market will get you, and I think that's something that we when we look at access to capital, it's part of that is the people. Can they raise money? Do they have good connections? You look at the shareholder list, who is in there, who can follow their money. Is it a 10 million market cap that already has 20% shareholders that all of a sudden they can't write meaningful checks anymore? Those things matter. But if and the quality projects tend to attract capital, but quality projects with quality teams certainly do.
This reminds me of Dave Lowton gave this incredible keynote at the Red Club conference a few months back, where his point was that, the most successful companies have strong backers. And I think this ties up both our 2 points of people and access to capital. So, the Ross B group of companies, the Pierre Lassonde group of companies with the respective backing, the Discovery group of companies, and there's a few more. Obviously, I can't be exhaustive enough to mention all of them, but we have moved into an era where your company needs to have that kind of backing, not necessarily a group like that, but you need to prove that you have the people and the access to capital for institutional money to believe in it and support it. And if you don't have it, I frankly suggest that you think about approaching them first and getting their backing, even if that potentially means a dilution to your own shareholder base, because they'll set you up for the future.
I think that's a good point. Now, we've probably just talked about two things that, on our list that, everyone talks about, right? People and access to capital. Are you the right people? Can they raise money? I think where something that's differs for us is something that we sort of, we were sitting, one of the things that we do as part of our research is we go to the Denver Gold Forum every year. And 2 years ago, we were sitting at the Denver Gold Forum listening to the majors present. What you're kind of hoping for is hints of where they're looking at M&A and what kind of jurisdictions they're looking at. And literally all of the majors and most of the big mid-tiers, they basically all were drilling next to our own projects. we're being capital, we're watching our capital, we're not buying things, we're returning capital to shareholders, and they're trying to operate their businesses like more. They're presenting the story like they're presenting it in general, a stock to a bunch of gold folks, and I think that's driven I think that's a shift in the industry. There was a time when 1 million ounces was a deposit that was likely to get taken out. And I don't think that's the case anymore. I think, the scale of what you need to find, from a gold perspective or copper perspective has moved up materially in order to get that potential takeout or even to be fundable to construct because of those things. And so since then we've sort of looked at scale with that kind of lens of, well, if these are the buyers of it, this is the best exit for us, one of the best ways to exit for us as shareholders. What does that look like? From a gold perspective, we're looking for something, that's going to produce 200,000 to 300,000 ounces a year. That's kind of tier 2 cash costs. So, if you, generally speaking, I mean, there's obviously a number of factors that go into this, but generally speaking, you're looking at 3 to 5 million ounces at 2 grams a ton. That's sort of the hurdle rate. And it doesn't have to be 3 to 5 million ounces today. It has to have that potential, right? There's that path to 3 to 5 million ounces. Sam, you ran the numbers on the copper side. What do you like? How does that translate, that same scale on the copper side?
Yeah, so copper is interesting because we're used to copper companies reporting on an aggregate basis. So typically we don't have this same level of disaggregation as we have with the gold companies. But typically what you're looking for is 300,000 ounces gold equivalent in copper would be divided 300,000 by half, so 150, and that'll be in millions of pounds. So you're looking for 150 million pound per year producer. That gives you something in the region of $500 million in revenue. If you look at tons, you divide it by 2,200 or thereabouts. So you effectively divide by 2 and take the 3 zeros out. So from 150 million pounds, you're going to 75,000 tons per year. That's roughly kind of like the level at which a project becomes interesting, not necessarily to BHP, but it becomes interesting to the people who we think are potential buyers in this market. And I think we're going to make an episode specifically talking about M&A on both sides, who we think is the most likely buyer and who we think is literally ripe for sale. And I think there are some very obvious ones. And I'd love to go over these and then revisit 12 months later and see how we did on our projections. But so in the copper side, just to go back to it, 100 to 150 million pounds or 75 to 50 to 75,000 tons per annum is roughly the number that we're looking at. And just to put this in perspective, like that's the scale of like a Mount Milligan or a Caserones at Lundin Mining. In gold, that'll be sort of on the low end. That'll be Valentine Lake, which is Marathon that was taken out this year or in the last 12 months. That's also Fosterville, for example. Even though Fosterville has exceptional grade, but it fits within that kind of orbit of the 200,000 to 300,000 ounces per year, which is again, that's kind of where both the seniors and the large mid caps would be interested in buying.
And frankly, that's where the companies like these effectively call them acquisition corps, new mid tiers that are being created, like an Eris Gold or an Equinox. That's the size that matters to them as well. That's what moves the needle, right? So the most likely buyers, if you will. The last thing is, and I think is probably critical, is will it be a mine one day? And this covers a bunch of different things, right? Like obviously, first is if it's of that scale, is there something? I used to describe it this way: is there something like this that's in production already? Will it be a mine one day? But that also covers sort of political and political risk. There's also, I remember when I first started as a research associate, there was a company in Mexico that had one of these 1 million ounce heap leach projects in Mexico, pretty typical. But the project or where the pit would be was in sight lines of a World Heritage site. Pretty confident that was not going to be a mine. And so there are things like that. So I think you got to kind of go through that exercise of, will this be a mine one day, and kind of check off some of those boxes, both the infrastructure around it, geopolitically, jurisdiction, what's that jurisdiction like? And I think jurisdictionally, you have to be more specific than a country, right? Peru is a big country. Where you are in Peru matters, right? Mexico is a big country. Where you are in Mexico matters. Although one could make an argument that
Canada is a big country.
where you are
in
matters,
Canada
right?
matters.
I would want to be trying to permit a heap leach project in the Yukon right now, as an example. I think that those things are, those things those things, right? What's around it, where are the, is there a mine in that jurisdiction? In the United States, as an example, I like places like Arizona and Nevada, but even within Arizona and Nevada, there are challenges to permit. And what you might be trading in, say, West Africa in permitting timeline, you're probably gaining in political risk. So I would say if you looked at our investments, we're very heavy North America. I think that's partially reflective of the cycle, though, right? We're taking, that in that risk stack, because we're where we are in the cycle, we've got higher commodity risk. There's lower access to capital. And so we're taking less political risk with our investment decisions right now. But that doesn't mean that we're against, West Africa by any stretch of the imagination. We certainly have investments there. And so it's just a question of where you're going to go. Well, I've talked about what we're looking.
Reminds me of Friedland when he says that God just put this asset here. It's not like you can get, you can pick and choose which jurisdiction you want to have this tier 1 copper deposit laid out.
Right.
You have to work with what you have.
Yeah, exactly. So, but I guess, what are the things, let's flip that around. We kind of looked at the things we look for and kind of look at, a couple things that are just straight no-goes for us. First and foremost, pre-revenue companies with debt. Debt is a straight out ticking time bomb. You have to repay that, and oftentimes the debtor ends up being the one in charge at the end, and dictates how things are done. And it generally doesn't work out well for equity. So we're, I never say never, but pretty very, very low likelihood we'd look at something, the development exploration space that had debt.
Yeah, so, as the equity holder, you're taking a substantial amount of risk on this type of project. If you tag along the upside down cap structure, you're just making a near impossibility to be successful as an equity holder. So for us, it's a non-starter, typically.
You might see.
So yeah, just to validate your point there.
I mean, you might see debt, feasibility stage projects at the very end, right before they're doing construction financing, that kind of thing. That's probably okay, but an Explorco with debt, probably not going to happen. Something that I think that we look at, but isn't necessarily a red flag for us is royalties. Maybe Sam, you want to explain that?
Yeah, so we think a lot of people on the street have this negative view on a royalty on an exploration project or a development project. We don't necessarily see it that way. We think it could be either way. And frankly, we think in many cases it could actually be a sort of stamp of approval. So you have call it tier 2 project. You're trying to get bankable funding. You're advancing and developing it, raising capital wherever you can. But then you have a royalty that one of the big royalty companies has put on it. The royalty companies, the big ones, spend substantial amounts of money and time looking at your project before they invest. So their investment in and of itself is a stamp of approval in the sense of technical due diligence, jurisdictional, regulatory. So in that case, we'd see it as a positive rather than a negative. So I think that's the point we're trying to make here is royalties are not always a negative thing. They could be a positive or a negative depending on where it is, how it's set up, how egregious it is. One of the mid-tier royalty companies nearly floundered early in its days because they were too egregious with the deals they signed with the companies, and they just literally were taking all of the economics out of the project. It doesn't work that way. There's plenty of examples. So you go back to the point, we are not against royalties. It's a case-by-case basis. And again, in some cases, it may actually work in favor of the project and the company.
And cognizant of the fact that you can only sell the royalty once. So if you sell the royalty when you're an early stage exploration co, it's gone from a project funding stack to build a mine. Or you end up in a difficult situation not to throw gasoline on the fire, but one of the things with Victoria Gold is that they have a heavy royalty structure already. Yeah.
So they have less flexibility going forward, correct?
And the other thing that, especially in Explorcos, that I found very frustrating when I was an analyst, I think it's very poorly disclosed. Generally speaking, you have to get into the financials to see it, and into the notes or into the MD, deep in the MD&A, which is what the property payments are for a project. Lots of times, they talk about, companies are very careful with their words. They control or have or whatever, but they don't say they own 100%, which means that they've optioned it, which is in and of itself is sort of par for the course. They've optioned that project from a prospector or someone else. But what are those future payments? If you're a company that's barely able to raise money to get, the next drill program in the ground, but 2 years from now, they have a $3 million bullet payment to acquire their project. Probably why are you spending money in the ground if you don't think you're actually going to be able to afford to fund that payment? So that's something that I think and it doesn't mean that those payments aren't appropriate or they can't be renegotiated, but I think you just, as an investor, you need to be very wary of, okay, we're in a tough market and there's a big payment coming out there. There is, barring managers ability to renegotiate, there is a possibility they lose the project.
100% agree with that. I think in the interest of time, let's move on to talk about the companies that we own that have made it through this vetting process and that are part of our portfolio today as we speak. And I guess we'll tell you why we like them and how they tick these boxes. So you already mentioned Arizona Sonoran and George Ogilvy. You want to give us a quick
this is a
brief intro?
Arizona Sonoran's for those who don't know it, it's a development project in Arizona. It's on state land, so it's a little bit different land ownership. It's not on federal land, so it's permitting paths a little bit easier in the United States and in Arizona, which kind of makes it unique from that perspective. It's a good project at its current scale. It kind of ticks the scale bar for us, but has the potential to grow, which is good. And so, has George Ogilvy certainly has the people, has demonstrated its access to capital, been able to raise money consistently. It fits in on the scale side, probably, it's probably on the scale side and probably closer to tier, at the border of tier 2, tier 3 economics. It is a large low grade deposit, but we're taking, we have lower risk on the people side. And so that fits in. And then, will it be a mine one day? I think so. I think it's one of the copper projects in the US that actually has a shot at being a mine. The thing that's nice about that investment in particular is that you have a situation there where you have this project is growing and you have sort of Rio Tinto lurking in the background with their Newton technology, which could be a significant lift for that project afterwards. So, certainly one of the names that we like and hold in a portfolio. Maybe one that people are probably a lot less familiar with is Bravo in Brazil. Sam, this was your idea, so I'll let you talk about it.
Because last year at Beaver Creek, I like to sit through the presentations, especially of companies that I'd never heard about. And I sat through the Bravo presentation, and I was quite impressed. Never heard about it. And they're in Brazil. They have a pretty solid project as it is. 4 million ounces plus of PGMs and nickel. Looks like a pretty easy kind of dig project. Good part of the country, surrounded by valley. And so we put it on our watch list. Then the stock decided to cut in half. And we were graced by the visit of the founder and CEO to Toronto, and we had a meeting with him. And later, that's when I recognized he's been a serial success person in Brazil. He's a geologist, sold multiple companies to majors, all of them sort of in the same area. One to Oz Minerals that now ended up in BHP, sold one to Vale. He's got 4 under his belt, I believe. And yet there is this really solid 4 million ounce plus PGM plus nickel, which is sort of out of favor, but there's all these exploration upside. So we start building a position in it. And very recently, they've put out their intercepts to this new copper sulfide area. that's moved the stock quite significantly back higher. And now it's looking like, now it's starting to look like tier one. It's tier one management, tier one deposit. Brazil, maybe not tier one jurisdiction, but still in the positive side. But for us, definitely something of great interest that we built a position in, substantially lower. We're deep in the money on that one. We're very happy with where we got so far. The CEO owns about 45% of the stock to his personal name publicly. So that for us is also a great kind of like telling sign of his commitment to the story. So that's one of those that has ticked the box for us as well.
All right, I guess the next one, sticking with the PGM theme, is a project in Western Australia. It's a company I followed for years. I know about it when they had assets in Canada, which is Chalice Metals. And Chalice, a few years ago, made a major PGM nickel discovery in Western Australia. And just for the record, we consider Western Australia the best jurisdiction in the world for building a mine. So if everything ranks below that.
Absolutely.
So, tier one jurisdiction, the people behind it, Chalice itself was a bit of a success on its own. They'd sold a few assets, they dividended out cash, they had always protected the company. And they obviously, there's the same group that has, I think it's Liontown is the other, is their lithium company. So obviously serial success from the management side, access to capital, they still had the discovery there. Obviously nickel and PGMs are out of favor, particularly out of favor in Australia, because BHP came out and said that they weren't going to need, they didn't think nickel was going to rebound for years. And then, so we met with them. Company had substantially gone sort of from $8 back to $1. We looked at it. They had $100 million in cash. They're funded through their feasibility study. So low access to capital. This is a world-class project. It has world-class expansion potential. We're pretty confident it's going to be a mine one day. And we saw the opportunity to start building a position again. Really fit the thesis.
And maybe, one of the things with this project has been metallurgy. They've done some preliminary work. The results have come positive. So we think that even though the stock has been coming off or has come off, it's now settled. The on-field work is actually advancing the project in the right direction. So sometimes the market gives you this opportunity where the project gets better as the valuation gets cheaper. And those are the perfect opportunities to accumulate. And I think this is one of those. And this is not investment advice. Everybody reads the disclaimer, but just to be clear,
we like this. We like the story. We think it's an asymmetric opportunity. So, one of the things with feasibility stage projects or companies we're working on feasibilities cost a lot of money. Because this has capital, we're not going to get hit over the head with a financing in the short term. So deviating a couple of nickel PGM names, which are interesting. It's not out of favor commodity, which is in and of itself as a whole probably maybe another whole episode. But maybe for a commodity that's a little more in favor is uranium, and so we have the uranium exploration play forum. You want to talk about that?
Yeah. So we've been following Forum for a while. I mean, Derek knows quite a lot about the uranium space, and Forum is the type of company that has a genuine tier one potential. They've already hit grade, but pre-discovery project in Nunavut. This, everybody's familiar with Saskatchewan and where the traditional uranium areas have been in Canada, but little people know that Nunavut has had significant exploration from both Orano and Kameke. Forum has a geologist that spent substantial amounts of time with Kameke exploring in Nunavut. She's very confident. She seems to know exactly what the structural geology looks like, what we're looking at. And this summer is the season where they're drilling for discovery. We have a position in the company. We're very excited about the prospects of it because it could open a completely new jurisdiction for uranium exploration in Canada, especially for the juniors, because there's still lots of ground available. Forum believes they have the best one, and so do we, hence why we've invested in them. But that's also one that has access to capital, has the intellectual human capital in the company to deliver a discovery. They're drilling right now as we speak, and we're pretty excited. And if you look at the chart, the company hasn't moved. This is one where it's not like susceptible to all the gimmicks of the market. This is a genuine not pre-drill, pre-discovery drill stage play. And if they hit, we think this could be a serial winner for us.
And I think the access to capital, as opposed to, say, we were talking about Chalice, that's a management team that's done it for years, and they get people will invest in them. Here you have a case with Forum where you don't necessarily have the same name brand of a management team that attracts capital, but because you have momentum in the space, there is capital for for those exploration dollars. Also, it's in Canada, so it's flow through eligible. That goes with that. And the last name is probably the best performing stock in the portfolio this month, or pretty close to it.
Yes,
is Midnight Sun, and so pretty heavy deviation from sort of North South America or Australia, which I'd consider to be the similar jurisdictionally. This is out in Zambia, but it's in the most prolific copper belt in the world. I don't know, Sam, go ahead on Midnight Sun.
Oh, this was incredible the way this came to us, because there's a private company in the US called Cobalt Metals. It's backed by a big number of billionaires, Bill Gates, lots of people. They engaged Dave Broughton, who was the geologist that made the initial discoveries at Kamoa and Kakula for Ivanhoe. He was very close to Robert Friedland in that discovery and the whole process. And we were looking at it as a private company, and we had no ability to participate in it. And we were just aware of it. And we realized that not a lot of people around us knew about it. And then Midnight Sun comes out, and they're just doing the roadshow. And they come to us and they say, well, we have an agreement with Cobalt where they're JVing one of the projects. It's an earn-in. They're going to spend X amount of money. They're going to drill this project. And they're going to drill it because Dave Broughton told them this was the key project that they need to get their hands on and drill for if they're looking for a tier 1 copper discovery. And it has all the right, it's in the right address. It's in Zambia, so not in the Congo, but it's close to the more traditional copper belt mines that we now understand extend into the Congo. That's where Ivanhoe is. So this is probably the most exciting copper jurisdiction in the world right now. And there's not a lot of exploration plays or frankly juniors in that space, because it's been widely acquisitive. So you have Barrick, First Quantum, Ivanhoe, it's all senior companies operating in the space. And now we have this junior that's backed by an incredible amount of capital and power, drilling this project that it's in the right address with the right people. We're incredibly excited about that one. And even beyond that, they have a side, we can call it a side project, but it's not even a side project. It will be a tier 1 project within a junior in itself, which is the mining of these oxides to fit a First Quantum mill nearby, Sentinel. So this is a company that was, to us, virtually unknown, but then they came to us with 2 incredibly exciting projects, working with real companies with real money in the right jurisdiction, right address. This is an Al Fabro company, and we just had no doubts when it came to supporting them. And so far, we're deep in the money in this one. We are incredibly excited for the exploration results, and I think there's more to come on this one, especially on the particularly on the cobalt side, which most market participants in Canada are completely unaware of what it is. And it is a big tour de force that's coming for the U.S. markets on this new mining cycle.
Yeah, and all those things are really exciting, and and they still have 100% on ground in that same land package, right? So where they've now got the money to they've got the money to drill, they're able to raise it. So that wraps up kind of what we look at for juniors, some of the names in our junior portfolio that we have. And I think at this point we'll wrap up episode 2. Once again, appreciate your feedback, constructive or not, and particularly if you disagree with our calls, and why you disagree with our calls, because we're happy to talk about it in episode 3 when we get there. Thanks, everybody.
If you think we're crazy, Let us know why you think
Exactly.
so that we can address that.